Let me tell you something the IRS will never put in a brochure. You work your whole life. You save. You invest. You do everything right. Then the day comes. You retire. You think the hard part is over. It is not. Because there is a clock ticking. And when that clock hits 0, the tax rules change. Not a little, a lot. Things you could have sold for almost nothing in taxes suddenly cost you a fortune. We are talking 37% in some cases, plus an extra 3.8% just because. I have seen this destroy retirement plans. People who saved millions, who did everything right, but they sold the wrong thing at the wrong time, or they held something too long. And the IRS took a massive bite. The good news? You have a window, a small one, before you retire, before your income drops, before the rules flip against you. Here are 5 things you need to sell before that window closes, and exactly how to do it without getting crushed by taxes. Chapter 1. Investments with big paper gains. First up, any investment that has gone up a lot since you bought it. Stocks, mutual funds, ETFs, anything you have held for more than a year that is sitting on a big unrealized gain. Here is something most people do not realize. The long-term capital gains tax rate for 2026 is 0% for married couples with taxable income under $98,900. 0. For single filers, it is 0% under $49,450. That is not a typo. 0%. If you sell after you retire, you might think lower income is better. But here is the problem. Social Security counts as income. Pensions count. IRA withdrawals count. Once you start taking those, your income goes up, and that 0% bracket disappears. I have a client who retired last year. He had $200,000 in gains in a tech stock he bought 15 years ago. He waited to sell because he thought his tax rate would drop in retirement. He forgot about RMDs. Now he is 73. He has to take mandatory withdrawals. His income is higher than when he was working. And that stock? He sold it this year, paid 15%, plus the 3.8% net investment income tax, because his income crossed $250,000. That mistake cost him $37,000. The play is simple. Time these sales for your lowest earning transition years. The gap between stopping your job and starting your Social Security. The gap before RMDs kick in at 73. That is your window. If you have already retired, you still have a window. The year you retire, before December 31st, is still a low-income year. Use it. Sell your winners that year. Pay 0% if you stay under the threshold. Then, reinvest in something diversified. Do not wait until RMDs start. Once those hit, your window is closed. Chapter 2. Your second home or rental property. Second thing on the list. Any property that is not your main home. Second home, vacation home, rental property, cabin in the woods, all of it. Here is why this matters. When you sell your primary residence, you can exclude up to $250,000 of gain if you are single, $500,000 if you are married. That is a huge benefit, but it only applies to your main home, not the beach house, not to the rental duplex. When you sell those, every dollar of gain is taxable, every single dollar. But here is the trap that destroys people: depreciation recapture. When you rent out a property, you claim depreciation every year on your taxes. It lowers your income while you own the place. Nice benefit. But when you sell, the IRS takes all of that depreciation back, and they tax it at 25%, not at your normal rate. 25%, no matter what bracket you are in. Let me give you a real example. A client of mine bought a rental property for $300,000. Over 15 years, she claimed $100,000 in depreciation. She sold the property for $500,000. Her gain was $200,000, but $100,000 of that gain was depreciation recapture. She paid $25,000 just in depreciation recapture tax. Then she paid capital gains tax on the remaining $100,000, another $15,000. Total tax bill on one property, $40,000. She had no idea until we ran the numbers. She thought she would walk away with $200,000. She walked away with $160,000. If you are going to sell a second home or a rental, sell it before you retire. Sell it in a year when your income is low. Sell it before RMDs push you into higher brackets. And for the love of money, set aside cash for that depreciation recapture tax. It is coming. Chapter 3. Concentrated stock positions. Third thing. This one is personal for a lot of people. Concentrated stock positions. Too much of your net worth in one company, especially if that company is your former employer. I cannot tell you how many times I have sat across from a retired executive who has 60% of their net worth in the stock of the company they worked for. They got stock options, restricted stock units, employee purchase plan shares. Over 30 years it became a fortune. And they will not sell, because they believe in the company, because they are emotionally attached, because selling feels like betrayal. I get it, I really do. But here is the problem. First, the market risk. One bad quarter, one scandal, one new competitor. That stock can drop 40% overnight. I have seen it happen. Enron, Lehman, Bear Stearns. People lost everything because they could not sell. Second, the tax risk. When you finally sell, you trigger a massive capital gain all in 1 year. That gain pushes you into the highest brackets. You pay 20% instead of 15%. You pay the 3.8% net investment income tax. You might even push yourself into a higher ordinary income bracket for your Social Security. There is a better way. For 2026, a married couple with taxable income under $98,900 pays 0% on long-term capital gains. That means you could sell up to roughly $100,000 of gains every year and pay no federal capital gains tax. Do that for 5 years. That is $500,000 of gains, tax-free. You do not need to sell everything at once, but you need to start before you retire. Chapter 4. Business interests or side hustles. Fourth thing, any business interest. Any side hustle that generates active income. Any partnership. Any LLC you started years ago and forgot about. Here is the problem nobody talks about. Self-employment tax. When you work for someone else, you pay Social Security and Medicare taxes, but your employer pays half. When you are self-employed, you pay both halves, that is 15.3%. Before you pay any income tax. I have a client who retired 3 years ago. He kept his small consulting business because he liked the work. A few clients, a few hours a week. He thought it was harmless, but he was still self-employed. He was still paying 15.3% on every dollar he earned, on top of his ordinary income tax, on top of his Social Security taxes. His effective tax rate was over 40%. For a hobby. There is another problem. Passive activity loss rules. If you have a business where you do not work enough hours, your losses become passive. You cannot deduct them against your other income. They get suspended. They carry forward. But if you die, those suspended losses disappear. Your heirs get nothing. The IRS says you need to work more than 500 hours per year to materially participate. That is about 10 hours a week. If you retire and cut back to 5 hours a week, you no longer qualify. So here is my advice. Before you retire, decide what to keep and what to sell. If you want to keep a business, commit to working enough hours, at least 10 a week. Keep good records, track your hours. If you are not willing to do that, sell the business, sell the equipment, sell the inventory, sell the goodwill. Time the sale for a year when your other income is low. Use the 0% capital gains bracket if you can. Pay the self-employment tax now, not later. And for goodness sake, do not let suspended losses pile up and disappear when you die. All right, here is what you need to do. Not tomorrow, today. First, open your brokerage account. Look at your biggest winners. Check your 2026 tax bracket. If you are under the 0% limit, sell. Do not overthink it. Second, look at your real estate. Do you own a second home? A rental? Calculate your depreciation recapture. If you are going to sell, sell before RMDs start. That clock is ticking. Third, check your single stock exposure. If one stock is more than 10% of your net worth, start selling. Use the 0% bracket each year. Spread it out, but start now. Fourth, look at your side businesses. Are you still self-employed? Do you work enough hours to materially participate? If not, sell. Or start tracking your hours. The window is open, but it does not stay open forever. Use it or lose it.